Okay, so all right, let's get started. So at sentiment timing, what we believe in here is that my name. Well, actually, let me start off with this before you do. My name is Gary Dean, and I started sentiment timing with Woody Dorsey a while ago. And like I said, we're not going to go into all that because we have a lot of existing members that are here. You can look at all that through our the recording that we did last week. But at sentiment timing, we believe that human beings and the markets are irrational, and there's always going to be an irrational element at work, and that is what creates market opportunities. Now we find these irrational points in the market through Woody Dorsey's proprietary sentiment database as well as his technical timing indicators. And as much as nobody's going to be 100% correct in this market. Anybody that says they are, you want to run the other way. Nobody is, but what you really want to do is put the odds on your side. And that is what using a master like Woody Dorsey, who's been doing this for over 40 years, gives you that trading advantage because you have somebody that's mastered this market, knows exactly when things are going to be turning, and informs our members of that. And really, the way that we use our market timing matrix is we use time, which is the is Woody Dorsey's technical timing indicators that predict when reversal dates are going to be happening in the trend. From there, we combine it with sentiment to figure out how traders are feeling about the market. And then from there, we use price, and that's technical divergences, support, resistance, and where things actually could reverse. So without
Let-
further ado, Woody, I'm going to
oh,
give this over to you, and you could just give a little quick explanation about who you are, and then we're going to go right into the market slides that we have.
Okay, so I've been studying markets and human psychology for 40 years. Um, I'm really good at what I do. It's not everything, but this product provides some information that is not available anywhere else because I've invented it and created it. And it has to do with the psychology part and also with the timing. And I'll give you some specific examples as we go along. So for instance, this market that we're in uh, now, and I think Gary's going to show the report, but we had a 0% bullish recently. Uh, Now what does that mean? That means on that given day we had a 0% for that day. Now people might think, oh, that's the greatest buy signal in history. Well, we get 0%, 1%, 2% at various times, and what I have told people is that the sentiment always has to be interpreted because all it really is a reflection of market psychology, and market psychology can mean different things at different times. So we actually had the 0% bullish on the 19th, and yesterday was 53% bullish, which doesn't particularly mean anything, and today it came in at 16% bullish because the market made a valiant effort yesterday to come off the lows. And indeed, it did. And I mentioned that this morning that it was quite a tale at yesterday's price behavior, and there are some indications for perhaps strength into tomorrow or Monday is something they pointed out over the last week. So it makes sense for the market to be doing a little better here in the very short term. So that just gives you a snapshot of what I see in terms of the sentiment behavior very, very near term.
And what we'll do is in a little while we'll go into we'll go into the report, and we'll give you details because a lot of members have questions about some of the pieces that are on there. So now what I wanted to go over, just with the sentiment is the missing link, and that's what Woody was saying as far as. But you have to be able to you have to interpret what it is and how to use it, and that's what he has mastered. And one of the things that Woody wanted me to pull up for you guys was was one of the monthly charts. And then from there, we'll just go into the report and then really
Right.
open this up for questions.
Right. So as Gary said, is that the sentiment always has to be interpreted. It's not a trading system. And I could talk at length about sentiment. You've heard of it, of course. People talk about it, but they don't really understand it. I mean, the typical way that people think about sentiment is either the market's all about fear and greed. Well, it's about a lot of things. There are a lot of different emotions. Is anybody here, Gary, do you know any human beings?
Do I? Yes.
Yeah, okay. So if you know human beings and you study human beings, you're studying the market, because the market is just human beings. There's nothing else. I mean,
Exactly.
George Soros or Janet Yellen, they never created the market. They're just part of it. Let's look at the monthly chart
You got it.
again here. So that's an important aspect of sentiment. Now I'm just going to what we see here is a longer term history of the market. And one of the reasons that we're doing this for subscribers as well is my comments over the last month or so that the market has changed and now we've gone into a bear market. And we've seen very dramatic action recently. So what does that mean? Now, for instance, John and Becky asked me about crashes and about capitulation. Now, capitulation is a very particular kind of low normally that happens, but it's rare and you have to determine the degree of capitulation. Now, what's curious is that I've had people around the world in the last couple of weeks say, hey, God, sentiment is really getting low. Isn't this a really great buying opportunity? And I'm like, no, not at all. Low sentiment has told you that the market psychology has changed. And you can see from this graph here, look at some of the big declines that we've had into the '09 low and also the '03 low. Those were really big declines in time and price. And now the market is really just beginning to fail. So we're in a new market phase, and it's always important to try to understand the slightly larger market phase that one is in. Before we were in a bull market, and then basically we were in a distribution trading range type market, and now we've entered into a bear market. So if you're a trader in a bull market, you buy the dip. When you're in a bear market, you don't buy the dip. You sell the blip. So this is what I've been saying. We have to be very, very careful here in terms of buying and selling, as this market has a lot of turmoil in it. And what I've been saying, and we'll get to it a little further along, is what we want to try to do is determine when the first, position or interim low is in place, and then see the rally from that, because after the rally from that, that's when you would set up for the next really big leg down, which should be a big money maker. So one has to know where you are in the market, and you look at this and you could see that we're far, far away from a capitulation low. Now, the other thing it's interesting in terms of crashes and capitulations is, anybody remember the bear market of 1987?
I personally wasn't trading that back then.
Okay. Well,
yep, there's people that are responded back.
That's cool. That's good. Okay, because as you know, that was not a bear market. That was just a correction in a bull market. It was very, very quick. It was dramatic, but it was very, very fast. I was there. I traded it. I saw it happen. That was fairly predictable. But the important point is that was in a bull market. So one of the characteristics that I think we're going to be looking at here is that the declines that are going to have started already are going to last for a while. Look at on this graph the two big declines. Those were a couple of years, 18 months, 24 months, etc. We're more likely to see that than a quick crash, because we're in a different market structure. So it's important as we go forward in terms of diagnosing both the intermediate term and even short-term movements of a few days and a week or two, to keep in mind that this is a different kind of market than we've been in for a while, and it won't be over quickly. That's very, very important. So you have to put that filter on. Okay, we're trading. The market is trading differently now. How are we going to trade it? Okay, why don't you go ahead, Gary? Unless there's any questions.
Well, there is. We have.
Cool.
All right. What do we have? Okay. John asked. Yesterday's low at 1812 had minus 3,000 net AD, 100 new highs, and
Yeah.
1271 new lows, and 96% volume being down. Is there? Do you have any thoughts on that type of, say, the tape, the interior?
Yeah, absolutely. Absolutely. The internals. Yes. And, we were in an environment where some kind of a low could be made at any time. It was a great tail that happened into that low. And as I said in the report today, that was probably a momentum low, maybe a third wave low or a C wave or whatever. And now the market can improve, but we can yet go down there again. So that was pretty dramatic.
Well, one thing
Yeah.
I want to show real quick, as we do it, this is just our live charts here, and when all this happened with this capitulation low and stuff like that, it took place right at long-term support on it. So the bounce in the long stick and everything that took place made sense on it. So it was, it wasn't like it just kind of turned out of the blue. Buyers came in at these previous, the previous support levels. So I thought that was pretty important, as well as the candle. So that's it.
Absolutely. And there was the 0% just before that, and the intermediate term sentiment and the near term sentiment, which we show in the graphs, was certainly in range where that could happen. However, remember, it is a bear market.
Right, Woody.
So
Somebody that sent a question over is late. They said that you were looking for some type of strength into the 22nd, which is in actually tomorrow.
tomorrow, yeah.
Being that we didn't really we the bounce,
Is that
even though we bounced yesterday, we were still down
yeah?
20, and we're bouncing today. Do those dates change at all for you, or do you view the markets any differently because of that? Because we didn't really get any good bounces along the way.
Well, having a good bounce today. Is
Right,
that
right.
Rick? Is that Rick asking that question?
It was actually via email. It came
Okay,
when I
no
was
worries.
putting everything together. Yeah.
No worries. Okay, so yes. So one of the things that is probably hard for people to understand, but is unique, is uh, I look at fractals of time. I look at time in all sorts of different phases, and so I can come up with in any given week, for instance, a day or two that I think will be strong, a day or two that I think will be weak, a week or two or three that should be strong, weak, etc. And I put those together in a matrix of time, and you come up with ideas. So the idea was even earlier in the week is that we could see some strength around 122, which is a Friday I'll get into, and then that may carry over into Monday. But again, that's like saying if I said to you, well, tomorrow, I'm here in Vermont, I said, tomorrow's going to be pretty warm, and it might be 32. Is like, what does that mean? You like gonna have a picnic? No, it's in the middle of winter. So remember, this is a big bearish structure, and so you take the shorter term idea of some upside with a grain of salt. Now, the other thing that I've mentioned going out a little bit further in time, and I mentioned this even a couple of weeks ago, is that even though we could see some strength, the market is still due to go lower into the first part of February, and one should also keep that in mind. And that timing, won't change. Now, we could talk more about how that might play out. So, for instance, if yesterday was a 3, a third wave low, a momentum low, and now we're going to recover here for a day or two, is we're probably doing some kind of 4, and I use this 4, that's a language, as you know, it's an Elliott wave language.
Yeah.
There are many languages in the market, but it is one language. So therefore, if you did that, then you could yet have another spell of weakness into the 5th or the 7th. that may or may not be as dramatic as what we just saw.
So this is what he's talking about. I'm just showing the screen, so it could be,
You see
yeah.
what I mean?
Yep.
And that would set up. And again, people now are very shell shocked, so they don't. People are like, well, I'm going to wait. Should I buy? And they're going to wait. So if we have some time here where the market, uh, calms down a little but still stays heavy, then when it starts to turn up again, people may psychologically be ready to play it
Well,
from the long
one
side.
one thing that I thought was pretty interesting today, and this is something I've been showing, is just this trend line that started all the way. It's going back all the way from the 2086 highs, and it was the minute that we saw the S&P, it was up, some 27 points. As soon as it hit this trend line, we saw sellers step back in again, and that's it. So we know that, just as far as price, because that's one of the aspects of what we do, is the bulls, until they really can get it above the 1892, the bears are in control. And that's just as far as putting time, sentiment, and price, the price part of it, the bulls got to get it above some of these resistance zones to gain any kind of confidence and see momentum going up
Right.
and see.
And that's why a better basing pattern makes sense here before one would entertain the long side for more than a day or two. So you have to give the market some time here to set that up.
Now, Woody, when you
And
say
once it
basing,
does, yeah,
wait, when you say basing, if you're looking at is this the type of basing that you're referring to, where we come down? This is going into the August low. We had a bounce and then we came back down again and it held this low. Is this the type of basing that you're
yeah,
referring to?
abs-
Okay.
yeah, absolutely, absolutely. So then people feel more comfortable, and then once it starts up, then people can get on board. And again, we need to identify some kind of a position or interim low so that then we can anticipate and play the long side counter trend and anticipate an interim type rally, which again I've said will occur in Q2, uh, from which then we'll be able to get short for the next leg down.
And that's
So it's like parsing where we are, all these different parts and pieces of the market. And inevitably, I think we will see at that next interim high, we'll see a string of 80, 90, 92% bullish, and price levels and all that to set up, so when it seems ripe for the next leg down. Now, what I will say again, don't be complacent. This is a big bear market, and a market doesn't always give you an opportunity that you think you would like to have. For instance, there's a lot of professional traders who might have been a little short or came in short or got short. They already covered. They covered and the market went down another 50 points. They're not really that short. They're looking for 1920, 1950, 1980. Are they going to get it? Maybe not. So you have to be very careful here.
Now,
Okay.
one thing that I think is important, because it kind of goes with everything that you've been saying with the where we're in an overall longer term bear market. And even though you're saying that there's going to be a great rally that's going to hit into in Q2, that would be the, say, interim rally within an overall bull market, but it will last longer than these little short-term bounces that are expected, say, through this week. So that's a short-term, we expected of a short-term bounce with an intermediate as well as a long-term bear trend. So come to Q2 is when, and correct me if I'm wrong on this, Woody, Q2 is the period when you think there will be say, an intermediate term low, and we'll get a larger bounce off of that, but it will still be.
No, 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 that's not what I'm saying. I'm
Okay.
saying in Q2 is when we're going to make the high to sell. Remember,
Oh, okay.
Q1 is over at March 30th. So, so we got a few steps to go through here. Now, you're looking at the monthly chart. I don't have a cursor, so I can't.
Where do you want me to point?
We'll look at the last two highs,
Okay.
the big highs, right? So the market comes down. Look at that one right there. The market comes down, right? and then it goes up. You see that little move up? It's
Yep.
3 or 4 bars up. Yeah, that was the sell opportunity. That's as far as it got. And then you were like, you know, the downside was wide open again.
And we saw the
So if
same
you
thing
look,
in the previous one.
yeah. So if you put that where we are, we get a pretty good push down here. Maybe we're going to um, you know, get a retest of the recent lows. And I can talk more about exactly what I think is going to happen because it was somebody's question. But basically, we end up with a point in time where people think, okay, we're going back to the highs or it's really okay. And that's when you start the next leg down. That's my focus for you guys in terms of when that might occur and how to get involved with that.
Exactly.
But
That's
you see it here. You see it here. This is, in other words, behavioral, real behavioral trading, or behavioral finance, which is what I really do, is about studying the behavior of the market. It's like trapping. It's like fishing. It's like hunting, looking at the patterns, the habits of the market and market participants to see when you can get involved. So that's what we're going to be looking for in this larger time scale. But I just wanted to bring this out because people may not know what a bear market is like. In this bear market, we don't know. No one really knows how big a bear market it is. I mean, somebody, I think Han was asking me, could we go to 1734 here? Well, I don't know where we're going to go. No one really does. But the question is, if this is a really big bear market, we could go back and test the 2009 lows. That's 666. Well, that's a long way from here, folks.
right, right. Woody, there's a few more
So,
questions. I'm sorry.
yeah, go
I'm
ahead.
sorry. Finish your. I thought you were done on that. I was just saying there's a few more questions that are
Yeah, go ahead.
well, one of them, May wanted to know that do you look at the Nemo McClellan indicator to determine washout low, or are you pretty much you just have your own kind of indicators that you look at?
I have my own indicators. I have my own experience.
Okay, all right. Then
Yeah,
we have Terry that asks. It sounds like you're seeing this market going below 1800, even down to 1600 on the monthly support line. Is that right? And roughly when?
right. Okay, so that's pretty interesting. So, first of all, I'm saying that it's a bear market, and there's quite a period of time left to go. Okay, which we see here. These are good examples of how the market trades. Now, you know, price objectives are very seductive, and I don't really focus on that. Other people do, God bless them. But no one really knows where the market's going to go, right? Like I said, if this is the bear market from hell, then we're going down to 666. You know, no one knows that. So it's better to focus on the shape and the timing to see let's let the market do what it's going to do. Now, one of the things that I've said recently is that I'm super bullish, in 2017. Well, that's a long time from now. That gives you a picture of exactly what I'm saying here. And I was saying this in the last few weeks. Now, I'm also realize that we'll get probably a really great buying opportunity in 2016. And, the market gives different opportunities. My position and what we do in the product is not to say, the market is doomed or it's going to do this or that for the next 2 or 3 years. I mean, anybody can say that. I mean, that's like, you see people on TV, they're either bullish or they're bearish for years at a time. What good is that? The point of this product is that I am able, with the timing tools and the short-term sentiment tools, to identify profiles within profiles to give shorter term ideas. No one else can do that. However, here we are potentially in this big bear market, is one has to be very careful about buying, etc. So the short term always has to be interpreted in the intermediate term, and now we have this longer term bearish potential here that always has to be kept in mind. Nevertheless, like I said a couple, 3 weeks ago, There is an indication for a low near the end of the month, early February. So just take it easy. Let's wait and see. And if we were to get there, and this would set up, then there might be an opportunity. And I think someone else had asked me, yeah, we could have a, 2 to 3 week bounce. And you'll see in the next few weeks, I'll be writing about, I already know where that first bounce is going to stop. However, it's going to be probably a compound rally. So we have to look at these things in terms of compound rallies and declines, where the market could rally for 4 weeks, decline for 2-3 weeks, not make a new low but be scary, then go up again in some kind of ABC type pattern. That's most likely what we're going to have to deal with.
Right. Woody, we have another question here. This is from Michael. He wants to know, what are your thoughts on the possibility of this decline being wave 4 from the 2009 bottom?
I don't really know. However, I think it's unlikely because the extent of the topping process that we've been in over the last 18 months, look at where the IWM topped, look at et cetera, et cetera. This is not a quickie. This looks like something that's a bigger structure. And you're getting some coordination here from, China and emerging markets and Europe together, which if you want to have a really good structural decline, you get them all together. And we've had some scares, before over the last few years where not all the countries and the markets have been in alignment, and they appear to be in alignment now. We're also seeing probably a quasi-generational kind of deflationary problem with crude oil that is one of the things that markets are focused on. These are the scale of some of these things are more typical of some kind of primary wave rather than a fourth wave, as he suggests. Of course, I could be wrong, he could be right, but that's not what I see.
Okay. Here we go. Now we have another question here, and it says, you are obviously applying analysis to the S&P. Presumably the same would apply to all other stock market indexes. If not, why not?
No, they would. They would. The primary focus of this newsletter is using the S&P 500 as a proxy. Do I look at the QQQ? Do I look at the IWM? Do I look at the Dow? Do I look at the DAX? I look at them all, because in the big picture, financial culture or financial equity culture is relatively homogeneous. So, yes, I look at them all, but we're focusing here on the S&P. So if you're trading, Germany, or you're trading, New Zealand or whatever, is these bigger processes are going to infect them as well.
Okay. There's a question from Adeline here, and excuse me if I'm reading these kind of crazy. The font is really small. It has many say that only a bear market happens when the yield curve is inverted, but it's not now.
Well, I still think it's a bear market. There's a very the Treasury market, and in fact, global interest rate markets are in a very strange, very unusual phase. Okay, they have been for a number of years. So this is an uncommon setup. Now, I could wax eloquent. I don't know how many of you have studied the history of interest rates at the time of Rome. Very interesting. Very similar to now in a way. And once the interest rates made their turn, that was a 20 or 30 AD, they went up for 300 years. In other words, this is a big turn here, and interest rates cannot stay at or near zero, for that long. And we're even seeing here that this whole QE ZIRP phenomenon is worn out its welcome in terms of being able to be really bullish for the stock market. So I don't see the interest rate environment as positive enough to prevent a bear market in stocks.
Do you think also, this is me asking a question on it. Like a lot of people are comparing the interest rates and everything, but it was such an uncommon thing that the Fed has done for the last, 3 years as far as pushing, keeping them down, that anybody that's using interest rates as history, they're really not able to match it up to history because we've never had a Fed that has kept rates down this low for this long. So it may be skewed, compared to what they may have used in the past. Because I've read where, when interest rates go up, it means that the markets are doing well, the economy is well, but in my eyes, I think they were held down for so long that it's skewing that whole thing.
Well, I think the standard analysis, and again, it's the rationalizations that people are using of what interest rates are doing, what it means for the stock market, is completely beside the point. I mean, the Federal Reserve is a new phenomenon, really. If you want to look at interest rate history, I said, go back and look at the time of the Romans. There's a very famous book by Sidney Homer. No one's ever heard of him. He's much more important than Ben Bernanke, I tell you that, about the history of interest rates going way, way back to the Romans, etc. And yes, in 100 years, someone will look back and say, this is just crazy what was happening with interest rates right now. So we're in this very unusual situation, and I don't think that one should get too excited about trying to read into the current sovereign debt markets in terms of what the stock market is going to do.
Okay. We have a question here. It says, can Woody please throw light on now this is from Venki. His dilemma is that he's not a day trader. But he's a short-term trader that trades derivatives, and he holds trades for 1 to 2 days. He tends to get fixated on Woody's time predictions, although I know we should not. Is Woody's method better suited for position traders over long-term time frames?
Great question. Of course, it's really up to how people trade, because I'm not really telling people how to trade. I'm just giving the benefit of my analysis in terms of the timing, and the sentiment. But I would say that, what I've been saying here recently is, there's some things, like I said, the market might make a high just before Christmas and then trade down into early January. There's a lot of ways you could have traded that. And here I've been basically saying, let's wait until we get into February 5th or 7th, and maybe we can get a 2 to 3 week rally. And then within that filter, he may trade for a couple days at a time, I don't know, or use more of a position. Of course, the ultimate, as you get deeper into trading, is that it's about risk management. It's about waiting for setups, and then it's about risk management. And, everyone has to find the comfort level in their risk management and the types of trades that they feel comfortable with. And there are different ways. He may find that he wants to have a little bit longer time frame on his trades, and then he may want to use the option market. Use call spreads or vertical spreads where he can stay in a trade longer. But risk management is the key, and even more so now that we're dealing with these very whippy markets, and I think they're going to stay intense.
Woody, one thing that I'll say is that just a clarification that we're in this longer bear market right now, because nobody's really. You first mentioned the bear market piece going all the way back into, I want to say August. You mentioned it, and you said nobody's going to realize that whether we're in a bear market or not, they're not going to realize it until we get into 2016. And now a lot of people are throwing out we're in a bear market. So no, having that information, and this is trying to help out the question that was just asked. Now knowing that, we know that the bigger picture is going to be down. We're in a bear market. So the dates that are put out, we're going to, whether they're going to be bounces, that's what we're going to use. That's what I use Woody for. Okay, well, is this going to be a bigger bounce, a smaller bounce? Is it a shallow bounce? And you coordinate your trades that way. But what Woody nailed it on is risk management and your tolerance to be able to to be wrong for a little while, or if it's not right, and you don't want to over trade and have a put all your eggs into one trade on it. So the fact that we have Woody that's given us these volatility dates, these reversal dates, as well as being able to look at where sentiment is, but then knowing the overall big picture within an intermediate term picture, within a short term picture, you can be able to manage your trades pretty well with that that kind of information. So I just wanted to add that on there.
Yeah, part of the issue here with talking about this bear market and getting it out to people, yeah, now everybody knows the market's been in big trouble the last few weeks. Is it surprising? No. The issue is we're going lower for longer than people think. That's still an important message, and therefore, in terms of trading, you need to have that as a filter. So when we get into this upcoming low, supposing you normally buy 10 futures, or you buy 10,000 shares or 1,000 shares, well, maybe if you want to be long, you're only going to trade 200 or 300 shares, or 3 futures contracts, whatever, with tight stops because of the overall filter. Now, the beauty of this situation is we're aware that we're in a bear market, but we don't want it to dominate all of our trading, because there's going to be some great buying opportunities to trade against, the overall trend here. And the beauty of this service is that we can look at some shorter term time frames of when to take, your risk. So don't be thinking, oh, now, hey, we're in a bear market now, I got it, so now you're going to go out right now and sell, 20 S&P futures because we're in a bear market. You might make money 5 months from now, but you could lose a bunch of money, over the next couple of months.
Right, right. So we have another question here from Paul. He's are you able to comment on the gold markets? Could this be the next big play, keeping in mind that we are now entering an equity bear market?
Well, gold is its own entity. Now, yes, I watch it, of course, very carefully along with everything else, and I also want to talk about crude oil for Terry. What you see, let's take a few giant steps back, okay? Commodities, oil, gold, etc., are all in a bottoming process, big picture. Does that mean you're going to buy and you're going to make a lot of money? Yeah, eventually, but it's a testing situation here, and it could still last, for a while, but you could get into, let's say 6 months or 9 months or 12 months from now where, gold goes up $1,000. It bases, it's got in trouble here, it's very much, and then eventually it does explode. So that's the structure, okay? And by the way, what's really important here in terms of that is that crude oil and gold are not the things to be looking at right here. The things to be looking at are the grain markets. They're going to be the first to go up in this beginning inflation situation. Now, the issue with gold, and you've seen, is it's just can't seem to get going. One of the big issues here is this, crude and this deflation story, but particularly the dollar. The dollar is still bid, and that's a big headwind for the metals. Now, I'm watching the dollar very carefully because it looks like it needs to go up and make a new high. And that could happen, in a month or 2 or 3. And when the dollar does make a new high and then reverses to the downside, that could become a really big signal for gold. And also for our markets. Now, I'm going to say that one of the surprises here could be that the U.S. equity market has basically been the relative outperformer, right, for the last few years. Now, what happens if it becomes the underperformer, particularly during this political season? I wrote a little bit about the politics today in the report that's quite interesting in terms of providing a negative view on financial markets. But if we get to a point where the dollar goes up and then makes a reversal and there's real trouble in the U.S. and U.S. markets, that could be a huge signal for gold. But at the moment, gold is just kind of, it's just kind of languishing here. So now Terry asked me about crude oil. I look at crude oil as well. Now, it's obvious that crude oil is dominating the thought process of investors because it's like, well, is crude up? Is it down? That means that, the stock market's going to go up or down. That linkage won't last forever, but it's important, important to watch. And it does look like crude has put in a short-term bottom and it's trading up here and helping the stock market in the very short term, but there's no indication that it has made its major low. There is an enormous longer-term influence on crude oil that it may take a year or something like that, or 6 months to kind of sort itself out. But as a talking point, as a market mover, it's probably achieving some kind of capitulation in terms of its rationalization for the market.
Okay. We have another question here. It has, Woody, would you like to say something about your timing process, excluding sentiment?
Well, there's so many things I could say, and I'll say two things that. I'll say three things. One is, I've made a very, very thorough study of time, unlike anyone else in the world. And let me give you an example, okay? First of all, Gary, you can be my answer man.
Okay.
So how many minutes are there in an hour?
60.
Okay.
Is there any difference? Now I'm all nervous about my 60.
Oh, I got you now. So what's the difference between 1 hour and another hour? What's the difference between 12 and 1 and 3 and 4? Just 60 minutes, right?
Right.
Okay. So is the Egyptians, for instance, postulated and showed that each hour of time is functionally different. So what happens between noon and 1 is different than what happens between 3 and 4 functionally in terms of the influence of time. So let me ask you this. Is there any difference between how the market trades between noon and 1 and 3 and 4?
Yes.
Yeah, there is. Absolutely.
People are wanting their positions. There's a lot that goes on, yeah.
So functionally, actually, time is different, right?
Yep.
And yet we all look at a 60-minute chart, right, or 240-minute chart, but there is something that goes on behind regular time that most people are focused on, So that's a clue. Now the other thing, and you know this as well, is that the market's going to close in 15 minutes, right?
Yep.
No, it's not. The market never closes.
Oh, okay.
Because the market is really just this complex of human cognitive emotional reactions. It's not just the bar chart. It's what people are thinking and feeling and doing, and it never stops. It never stops. Once you realize the market is an entity, it's not just the bars. And you can see this, how this occurs. Of course, now you have 24-hour trading and, China, et cetera, more and more. But I mean, for instance, when the stock market was closed, was actually the exchanges were closed after 9/11, after the terrorist event. It was like the market was in a coma, right? There was no trading. And yet, all people talked about all day long. That's all they thought about. What are my positions? What am I going to do? The market never really closes. So there's a whole different way of looking at time. Now, I look at different scales of time and I kind of fractalize it in terms of shorter term, longer term. Again, supposing I said, which I'm saying, okay, buy them in 2017. Well, what good does that do you? What are you going to do with that? But if we look at things where, tomorrow could be up again because there's some short-term phenomenon, that's interesting. And then we look at the dates I'm talking about, February 5th or February 7th. What day of the week is that?
Actually,
It's
not
Friday, Monday.
okay.
Friday, Monday, right? Friday, Monday is a very important situation. That's when the physical exchanges are trading because you often see if a market closes very weak on the Friday, then the market isn't really closed because over the weekend people are really focused on it, and then it can open lower on Monday morning and have the Tuesday turnaround. So different days of the week are actually different qualities of time. And I had this one fellow, Lewis, I don't know if he's watching this, but trades a lot just on Fridays. Well, last Friday was very different than I think than this Friday is going to be, but one has to look at this in terms of fractalizing the timing, and that's where some larger timing factors come into play in early February, and it'll be interesting to see the Friday, Monday, setup. So there's just so many timing modalities and matrices that I look at, and what I can tell you for sure is two scary things. One is, this is what I do. Other people do pole vaulting. This is what I do, and I can already tell you when some of the highs and lows for the year are going to be. I can also tell you for sure, after doing it for 40 years, is I realize nobody knows anything. Anything can happen, and you really have to be very careful, which is why it really is not a good idea to put out, oh, the market is going to bottom on, June 30th. The market's going to crash on that day. It's the end of the world. You see, it's sort of the end of the world phenomenon because a lot of things can happen, and you constantly have to be sensitive to and modulate what's going on. So, for instance, if the market is up 1,000 points tomorrow, that's pretty interesting. That could mean something a little different. So we have to be very careful about timing, but it does give us a good guideline. So, for instance, when I'm talking about this low that's going to happen, in a couple of weeks, I guess it is from here, is people may think, oh man, the market's going to go down for 2 weeks, just like it did last week. Well, I don't think it's going to do that, but it may rally for a few days, another 2-3 days, and then it could go down for 3 or 4 days, and then go up for another 2 days, and then down for 3 or 4 or 5 days. And whether it goes down to 1773 or 1812 or 1843, I don't care. But if it goes up, 100 S&P points for 2 weeks after that, then that's a great trade. That's my focus.
Right. We do have another question here. This is from Adeline. It says presidential years have historically been bullish for the stock market. Can a bear market happen in 2016? I'll just give you a quick answer on that one. 2008 was a bear market. That was the last presidential election year. So that theory is not 100% correct on things, but
Yeah,
I'll let you.
yeah, no, that's absolutely right, and that's a good. It's always good to know what some of these larger things that people are talking about are, et cetera. Of course, everyone knows about these larger, tropes, market tropes, and but they are what they are. What I'm finding in talking to people in general is that people all of a sudden are realizing that we're going to have a different president, and God only knows who it's going to be, but it's, things could be different. And I think in general, this political process that we're in, this presidential election, which is going to be pressing on us more and more, I think in this particular case, there's a lot of uncertainty and angst, and it does create, I think, a negative overall climate for the market.
Well, another thing that I just what you just mentioned with the we're getting a new president. Think about the last two times we got a new president and the market collapsed. Those are the last two bear markets we had. And if you go and you look at 2000, that's when George Bush came in. And then in 2008, I'm sorry, 2000 is when he came in. But then in 2008, we got a new president, but that market was already down and it's up. So there's, the new president thing. It's either it is a big deal. It seems to the markets because each time we get one, there's some type of big move that takes place, during that. So we have another question here. All right. It says, can you say when you think the highs and lows might be approximately in terms of time?
Oh, sure. But as like I said, that doesn't really help you that much. Now, for instance, remember in 2014, we had the black hole that was due around October 13th. Now, if I had focused everyone on that 3 months ahead of time, wow, I'm going to make a lot of money, I'm going to short the shit out of this, et cetera, et cetera, et cetera. But that trade was really only operative from when we made the high in September 19th. So the 3 weeks from there were the place to put that trade on. So that's where, like I said, if I say the market's going to bottom in 2017, and you're like, I'm putting on the S&P shorts here, that doesn't really help. And the other thing is, like, one of the key things for subscribers here is going to be looking at this shorting opportunity or buy in Q2. That's what I'm focused on. Now, I have a few different dates in mind, but if I said to you it's going to be April 1st, you'd be like, oh, yeah, I'm going to buy my puts that way or whatever. But, what we want to have here, you have to follow this. Remember, the market is a story. It's like a novel. We need to make an interim low. Then we need to have a bounce, and then some kind of retest or setback, then another bounce, another identifiable compound rally. Then we need to see some high sentiment. That could happen in a few different time frames, for this to set up. So just to have a date by itself is really a disservice, and it's a disservice to me cognitively because I don't want to become anchored myself that, a certain thing is going to happen on a certain day. That's not really useful. But
And
you know,
we've seen things change also, like in the, just
yeah,
from what you were expecting, and that's the one of the benefits of getting this information, as soon as we put it out is I mean, Woody has changed, his view on what he was expecting, but it usually took place not on a say a bad call where it didn't do what was expected, but it didn't go down for the time frame that was expected, and then it took out a sentiment resistance level, and that changed the view. So what he's these things, everything that he's saying, they're each week something may change here, it may change there, and that's what he does and why he studies and why I enjoy reading it. It's really helped me out as far as with my just the way I view the markets. You look at them in a lot calmer way than the majority that are out there, and I know it just from talking to people. They're petrified right now, and if you take a step back and look at things, yeah, they're going to be right being petrified, but we're only 20, 30 points, whatever, below what happened in August. But now everybody's panicking on things, and it's so that knowing this, what is going to be playing out, to me, it's changed the way that I view the markets. So I'm sorry to interrupt you on that, Woody.
no, that's fine. That's right. You know, you have to have a subtle. You have to develop a flexible, subtle mind. And I know everyone likes the easy answer. Just tell me when it's going to bottom. It's like, you want somebody to give you a golf tip. Well, you know, just email me a sentence so that I can hit the ball 400 yards. Come on, just tell me how to do it. It's not so simple. It really isn't.
That's really
You know,
funny, that analogy with the golf. Yeah, I want to hit the ball straight. It's like, hey, put your head down and hit the ball. And
you know.
99.9% of the people won't be able to do it. So it's there's instructions that have to be done. But I think that's pretty much we have a those are all the questions, and I don't want to keep everybody, forever. And I think this is a good start to what we want to do. Hopefully, that we're going to be able to, because really the whole piece of this is to answer questions and get everybody accustomed to who Woody is. And we did open it up to our regular people, but we're probably not going to be doing that all the time. We're going to keep this internal to our members, where you can learn, listening to what he says, and somebody that's been experienced in this market for so long. And it really does give you peace of mind on when how to view what he's reading, and not to be like, okay, well, I have to hold this date down, and if it doesn't hit, he's wrong. That's not it. It's like what he said, this market is it's changing all the time. And as much as there's there's a date, and like I said, in the past, some dates have been spot on that he called the month before. But it's more just getting that idea of what to expect. And if you think that, if he's telling you that there should be a top coming on this date, and things are lining up, and this, then you have more confidence of taking a short position. And the thing is, even if you're wrong, even if it's wrong, and it's off by 20 or 30 points on the S&P, just if he doesn't change his view on, okay, we're still going down, you can actually just kind of ride that position a little bit, longer, because you kind of know that you have one of the best market timers in the world saying, no, we're still going to be getting pulled down. And before you know it, it's, you're in the money on the trades. And we're not a trading service, but I'm just saying the peace of mind that you get from listening to what he says, and you become a better trader yourself. You understand what he means by these things, and it really does. It changes the way you look at these markets. So hang on, I think we have
Right.
more to.
I think, can you hear me?
Yep, I can hear you.
Yeah. So I think Gary does a very good job in terms of modulating this with his technicals, where, like we've been saying here, the sentiment has been so extreme. Hey, this is not the time to press the short side. Yeah, the market can go lower. We think we're in a bear market, but it's not a good time to press, on the short side. And now we're saying is, it's interesting close today, pretty good close, is we probably be up, tomorrow or maybe into Monday or something like that, and then we'll drift down again. Um, you know, so trade
Um,
accordingly.
exactly. All right. What do you, can you give a roadmap for the year, so as to help us what to expect?
No,
I mean, Adeline, I think really the best the roadmap for the year is been said on the. It's a bear market. Where the bigger trend is going to be to the downside, and to go into more detail on it, like what he said, wouldn't really be giving you any. It wouldn't be good advice for you, because you can't really trade off of that, because even though the overall bear market for 2016, they just like he said with a river, it's not going to go straight. There's all curves going in and out.
that's
So
right.
the overall is, it's a bear market in 2016, and I think that's probably the best roadmap you can have. Um,
Right. Now that's a good point. I was going to say it's interesting because the best so again, as Gary said, just keep reading, because we're going to be following it. And actually, of course, and you brought a good point, but it's not really a roadmap. There's not really an absolute GPS. It is more like a river, and I've talked about that. And the next time we talk on like this, I'll give you a story about the river, how the market is like a river specifically. And I may do some more sort of market tales. That would be a good one to tell you. I'll tell you also how I personally became acquainted with one of the greatest traders in modern history that you've never heard of, and how he traded, and some other personal anecdotes that may shed some light on the market.
So
Okay, next time.
Terry asked. I mean, he said he liked this, enjoyed it, and he wants to know if there's going to be more webinars. And Terry, that is part of the plan. We don't want to set specific dates for each week, but it's something that we enjoy. I enjoy it because it allows you guys to listen to Woody and get to know him on a little bit of a personal basis, just listening to how he does the markets. And Chuck, they're that everyone seems to be liking this, and I think it's you guys are going to enjoy it, and that's why I want to kind of keep it at an hour right now. We don't want to go because we're going to have another one, and we are, like I said, we're going to be opening this
Yeah.
to our members, and we want you guys to be members, and we're going to try to do in more informative stuff, and we want to make you guys understand this market through Woody's eyes. I know just from working with Woody for the last 2 years that I know absolutely nothing about the stock market. And every time I read the reports, because I read them, I have to put them out to everybody, but I read them. And then when I talk to Woody, I learn a little bit more each time. And that's what we really want these to be, is where you guys become better traders, not it just in mentally wise, where you're not going to be panicking over things, and you're going to be learning, not maybe specific things that Woody does, but how to view it and how to take that overall big, view of the market. So we have one. Is there a yes? There's going to be a replay that's going to come out, and we're going to. I'm going to send that out. One thing for anybody that is a new that's not a member, what we are doing. Let me just get to my page here on it. What we're going to be doing, because like I said, we want these to come out. We want to be doing these, as much as possible, but not without putting exact times on it. We're doing for this webinar. The first 20 subscribers you're going to get 50% off for the first 2 months. And I'm going to put the link right in here so you guys can just click on it. I'm going to put it in the reply to all part here, so you should be able to get it. Send to all, and I'm also going to put it in the chat part. And like I said, if you guys are, if you're interested, we're doing this is for the first 20 people that sign up on it. I'm going to be sending out a replay, and hopefully we're going to be able to do these. And we're not going to say commit to once a week. We may do them once a week. We don't know, but it's not going to be set times. We're just going to let everybody know. But it's going to be just to members, and we're going to keep trying to educate people and let you guys know how things work. So with that, oh, you can't hang on one second. How about look in the chat part of it, Brew. There's a chat. I just sent it via chat as well. And if not, I'm going to send it via email as well. So hang on one second. Let me try this one more time on it. So chat. I'm going to this paste. All audience send. Now in the chat part, can you, yeah, I'm going to send it via email. If you look in the chat, then you could, you'll be able to click on that. But like I said, this is something we're going to be trying to do as much as possible. You're going to be able to listen to one of the best market timers in the world, and hopefully you're going to gain, some knowledge out of this. And I think today went fantastic. Woody, I appreciate you taking the time to talk to everybody. And that pretty much does it, unless you have anything else you want to say.
No, we'll talk to you next time.
You
Thanks,
got it.
everybody.
Thanks, everybody.
All right.
Take care.
Bye-bye.
Brew, it's going to be going out to everybody.